Welcome back to the next video in the series. This is Positive Theta Trade Management, the video series in which we go over various option strategies that result in a net positive theta in our brokerage accounts. If you like the video, please be sure to leave a like, share, comment, and subscribe. And let's get right into this next video in the series. First and foremost, my apologies for missing the upload last week. I was very busy and I did not have time to upload it that Friday, and subsequently that weekend I was planning on uploading, but time just got away from me. I had a lot of family events, but that's besides the point. I'm not going to be going over a specific trade. I'm going to be going over managing an account and basically going over options theories, the Greeks, how options really work in the sense of managing it on a day-to-day basis. And I want to just present it in a way that's very analytical, very objective, and in the easiest way to understand. So I wanted to start this off by going back to the basics and really drilling it into you what it is when we're trading options. So starting off here with the long call. With a long call, you have theoretically unlimited profit. A call can go to infinity because the stock can go to infinity. Will that happen? Probably not. Your break even is the point at which you're making any profits or losses. So let's say you buy a call and let's say the strike price is 50, and let's say you paid $1 for that $50 call. So your break even would now be $51 per share. You're adding the $1 on top of the $50 call. Let's say the stock is trading as well for $50. You're buying the at the money call for $1. It is a $50 strike on a $50 stock. This is the point at which you will lose the full $100 or the full dollar that you paid for it. In options quotes, it's times 100. We will lose the full $100 if the stock price is lower than $50 on the expiration of the option. The point at which you are making any profits at the expiration of that option is if XYZ is trading above $51 per share. Because remember, you bought the $50 call, $50 strike call, which gives you the right to purchase 100 shares of XYZ at $50 per share. You paid $100 for the right to do so. So now your cost basis, if you were to choose to exercise that option, will be $51 per share of XYZ. Moving on to the flip side of the long call is the short call. Let's say that you want to sell the same $50 call of XYZ for the $100 premium that we used in the previous example. By selling the $50 call, you have the obligation to sell 100 shares of XYZ at $50 a share if the option is exercised before the expiration or if your call is in the money at expiration. It is in your best interest for the call to stay at or below $50 of the stock price at expiration. If the stock is at, say, the $52 example that we used in the long call example, your call will now be $2 in the money, and you originally received $1 in premium for selling it. So now you will be at a loss, theoretical loss of $100 because you have to sell short 100 shares of XYZ at $50 a share as you had originally stated by being the seller of the call. Moving on to puts, these are the exact opposite of calls. Instead of having the right to buy 100 shares of stock, puts give you the right to sell 100 shares of stock. If you are long a put at, say, the same $50 strike price of XYZ, and you pay $100 for that premium, you are basically saying, I have the right to sell 100 shares of XYZ at $50 a share in the near future, and I am paying $100 for that right. Using our original example, at expiration, XYZ moves from $50 to $48. Now that $50 put that you had originally bought when XYZ was at $50 per share, it is now $2 in the money. You paid $1 for that. So your effective cost basis is $49 per share. But since we said it was $2 in the money, your profit would be $1 per contract or $100 if you chose to sell that option. It is important to note with the profit potential of a long put, the most that you can make on a long put is the distance between the strike and zero, because stocks can only go to zero. Moving on to the risk profile of a short put, when you are selling a put, you are required to purchase 100 shares of that stock at the strike price that you are selling at if the option buyer chooses to exercise on or before expiration. Keeping our original example of XYZ at $50 per share, let's say XYZ is at $50 per share and you decide to sell the $50 put. You are required to buy 100 shares of XYZ at $50 per share if the buyer chooses to exercise and you are put the stock, which means you have to take assignment and you have to purchase 100 shares of the stock. So using our same example, we're selling the $50 put and we are receiving $1 in premium for doing so. Our effective cost basis per share, if we were to get assigned, would be $49 per share, aka our break-even point. Simply put, when you look at the risk profiles of the various option strategies, of which there are 4 main ones, which is long put, short put, long call, short call, you can gain an idea of where you are making profits and where you are losing. When you look at a risk profile of an option, there are 4 potential risk profiles that you are looking at. There's the short put risk profile, long put risk profile, long call risk profile, and short call risk profile. These 4 risk profiles are used in combination to form some of the more complex option strategies that we trade. So I have Tastyworks open right here, and I'm going to give you guys an example of what a net seller of options portfolio should typically look like. I have currently in this brokerage account, as you see right here, 142 Thetas with deltas of 27, generally a positive theta with high probability of profit, and you're selling these options in high implied volatility environments, you will make money a large percentage of the time. So let's take a look at this space strangle that we opened today. We'll see here that space has a IV rank of 70, which is very high, and let me move this over here. You'll see right here that there is 152% implied volatility in the August 20th option expiration cycle, which is also 45 days until expiration, 49 to be exact. So what I did was I went out to the $35 put. I am selling the $35 put. Going back to the original example, I am required to buy 100 shares at $35 a share if the buyer of this put chooses to assign. Right now, Virgin Galactic Space is trading at $45 a share roughly. So this put is $35 per share. So right now this put is out of the money, as we see the in the money, out of the money strike line right here. This is out of the money. If we pull out the out of money percentage, we'll see that this is currently calculated as being 58% out of the money. And we are also selling on the call side the 85% out of the money call. So here we have the risk profile of space pulled up, the strangle that we have open here, the 967 to the short call, which is 70. So our break even is about 79.67, exactly 79.67. And our break even on the put side is subtracting the 967 from the $35 put. 967 minus 35 is our break even on the put side. As you see right here, we have $17.38 of theta every day getting added to theoretical value of our spread, or I should say decayed in theoretical value from our spread. Now, let's go back to our overall portfolio and take a look at some percentages. Taking a look at our probability of profiting on this trade, right now for the total strangle, we are sitting at about a 69% probability of profiting, with a 71% chance probability of profiting on the short put and an 82% chance probability of profiting on the short call. The short call, as we go back to the table over here, has some pretty high implied volatility compared with the put. There's some high, what we call skew, as we are selling the put with implied volatility of 145% and the call with 165%. Moving back over to our positions tab, let's take a look at some of the other trades that I currently have up. So I pulled up another strangle trade that I have open here on natural gas futures. I am selling the $3 put and 4 1/4 call. Now, these are futures. These are quoted differently than stock. So I received $1,080 for opening the strangle, which is quoted as 0.108. This is times 10,000 to get the tick value of $10 per point, which is the point value right here. This 8 is the lowest point that natural gas can trade for, which is $10 up. So if I sold it for 109, that would be $1,090. I sold it for 108, which is $1,080. Currently, they're trading for 104 ask, 99 bid. So the mid of it right now is 102. If I were to close out the trade and get filled at 102, I would make about $60 on the trade so far. I'm looking for about 50% of the max credit that I sold it for. So I sold it for 108. I'm looking to close it at about 0.054, and realizing 50% of the original credit received. So on this trade, if we go back to the positions tab, I am currently positive 24.31 thetas. So I am getting $24.31 of theoretical value decayed in my favor because I am positive theta every day as I have this trade opened. What I mean by that is, let's take a look at the top right EXT value of 7,600. What this means is I currently have $7,600 worth of extrinsic value that I am looking to milk over the next coming weeks as I close out the trades that I currently have open and look to realize the theoretical value that has been added to my account after each day has passed and the thetas work in my favor. That's all I have for you guys in this video. A bit of a different video, didn't really go over one specific trade, just trying to go over how calls and puts combine together to form a net premium, net positive theta in our brokerage accounts. If you liked the video, again, please be sure to leave a like, comment, share, subscribe, and I hope to see you all in the next one.